All right. Good day, everybody. This is Brian Davis with Independent IRA, and I'm happy to be joined by my co-host, Brock Vandenberg of Talimar Financial. Brock, thanks for doing this. Yeah, thanks for doing this again, and hopefully we'll keep doing these on a quarterly basis this year. I think last year we only did one or maybe two. But today, again, we're going to talk about a very popular topic in real estate investor space here, especially in Southern California, on investing in trust deeds using a self-directed IRA and 401k. So a little administrative stuff before we get going. All you listeners are on mute. You have the ability to raise your hand and type in a question, or also in the chat box, and we'll either get to those at the end, or we'll try to answer those during the middle to see how it goes. We are recording this, so if anybody has to jump off, you can email Brock or I later, and we should be able to get you a recording. So we'll get going here. First, it'll be me mostly speaking for about 15-20 minutes, and then I'll hand it over to Brock, and Brock can go into the meat of investing in trust deeds here as I get into self-directed IRAs and 401ks. The first disclaimer, I always have to say, independent IRA or active plan benefit services or retirement checkbook, the companies I work with and represent are not investment advisors. We can't provide any investment advice. All information is for educational purposes only. Please consult with your financial professionals before entering any type of investment. So with that out of the way, independent IRA. So I help people with their administration of self-directed IRA accounts, as well as setting up self-directed solo 401k plans. So I've been in this space since 2009, so about 8 years now. Time flies. Prior to that, I was mostly doing residential real estate loans. After graduating college in 2001 from UC Santa Barbara. Originally, I'm from Northern California in a small town called Yuba City, where my parents are rice farmers. So I've been involved with real estate my whole life, but it's been very exciting these last 8 years to help educate people on self-directed IRAs and solo 401ks, as well as doing investing in my own self-directed IRAs and solo 401ks. So we'll get going here. So a lot of you on the phone call I saw from who signed up have a little bit of experience with self-directed IRAs, but not everybody does. People have been learning more and more, but a lot of attorneys and CPAs, you know, they have such a broad sense of what they do, whether that's in accounting or the law, that it's, you know, they might not have the focus to know where a self-directed IRA can come in and fit for their clients. And same with the financial planner. They're specialized in securities, stocks, bonds, mutual funds, where we're here to help people that want to invest in things outside of the stock market with their retirement accounts. Things like trust deed investments like we're going to talk about today, or real estate, or investments in other non-publicly traded companies. So we consider ourselves a self-directed IRA custodian that I work with, and that we can hold these types of assets where the brokerage houses don't. Now, a lot of this
Brian, I got to say, if I can jump in real quick, Brian.
Please
I can tell you, I've been working with Brian for, I don't know, almost 8 years now, Brian. He set up my self-directed IRA and 401k. And the more and more I learn about this, and the more and more I talk to other investors that utilize their self-directed IRA, you begin to recognize how big of an industry and how big of an opportunity using a self-directed IRA can be to invest in things other than your traditional stocks and bonds and whatnot.
That's exactly right. And, you know, this graphic is a little old. I got to get this thing updated here, but there were $7.2 trillion in IRA assets at the end of year 2014, and less than 5% of those were in an alternative investment space like what we're talking about today, like a trust deed investment. So the market out there is huge for this. Now, I'd imagine this number's gotten bigger with the way the stock market's gone. So clients, IRAs, and 401k. So this is just IRAs, this number. If you count 401k.
This 7.2 trillion number isn't just the funds that are in Mitt Romney's IRA account, is it?
No, he only has a couple $100 million, so everybody else out there has a chance to gain in the space.
To catch up.
But yeah, so the key concept here, like we're talking about, is we're here to hold these types of alternative investments. Real estate, precious metals at times, private notes and loans, like what we're going to focus on today, and investments in private companies. So we're seeing a lot of investments in startup companies and other companies that aren't publicly traded yet that do want to take on investors. And we can help handle that, investment for you if you have that investment in place. So here's a list of some, different types of investments that we see out there. You can invest in trust deeds and mortgage notes like we're going to talk today. Probably the most popular investment I see, investments in tax liens, limited liability corporate companies, raw land, lease options, the list goes on and on and on. The truth is, when these rules were written in the ERISA Act in the early 70s, it never listed what you could invest in, really just what you couldn't invest in. And they made some rules of things you couldn't invest in. One of the things is life insurance contracts with an IRA or any type of collectible. And this is a list of some type of collectibles that the IRS lists. So a work of art, a rug or antique, metal or gem, an alcoholic beverage, or anything illegal. You'll see about any stamp or coin, and the reason is they made some changes to this to allow certain types of precious metals that are allowed inside of IRAs, and they did that a little bit later. But besides these things that you're not allowed to invest in, like we just talked about, there's what's considered prohibited transactions. Now, I know it's a big jargony word, but a prohibited transaction is when your IRA gets involved with a disqualified person. So using big words here, but who's a disqualified person from your IRA? And here's kind of a list here. You are disqualified from your IRA. If you're a fiduciary of the account, it's your IRA. Your spouses. And then you kind of want to think about this in a straight line up and down. Your parents, grandparents, your kids and their spouses, grandkids and their spouses are disqualified persons from your IRA and can't receive any type of personal benefit from your retirement account. So you can't buy a piece of property, rent it out to your college-age kid, even if they are paying market rent. They just can't have any hands-on to it. You can't buy a property and use it as a vacation home. It has to be a pure investment. So, and this also goes along with disqualified persons, any company in which you are a majority owner of or have some type of management control in. And I'll get into some examples here because you don't want to mess with the IRS, as this slide shows here. So we'll get in a little game. I know this game is a bit outdated. I'm going to have to come up with some new game shows that are on TV now to play with this game. But everybody probably remembers Deal or No Deal. And in this case, could your IRA lend yourself $10,000? The answer to that is no deal. You can't lend yourself money from your IRA. That is self-dealing. That would be what's called a prohibited transaction, as we just discussed. Now, what about your brother? Could I lend my brother $10,000 from my IRA? The answer to that is deal. He does not fall on that list of disqualified persons set out by the IRS. And so I could lend my brother money. I don't know if I would actually lend my brother $10,000, but I guess it would depend on what he's got going on. So I got some trickier ones coming up here. What about your stepson? Could I lend my stepson, if I had one, $10,000 from my IRA? The answer to that is deal. If it was my son, it would be no, but stepson, for some reason, is okay. Now, a little trick to some of these rules, if there's some underlying benefit, you lend your stepson money, and then he goes and invests it with me, that would be me circumventing the rules in what's called the indirect rule violation. So you can't get around the rules by moving it to point A and then moving it over to point B as you wanted, if that would be prohibited. And one more spot here. Could I lend my daughter-in-law $10,000, deal or no deal? And the answer to that, no deal. Kids and their spouses. So again, these rules can be a little fickle. It's all in one Internal Revenue Code 4975. It's one of the things I like to point out to people, CPAs and other advisors, of where to look for some of these rules. And you can also, contact me if you have questions about specific scenarios for you.
Hey, Brian, I've got a question.
Yeah.
I have a lot of investors with me combine funds from two separate self-directed IRA accounts. So maybe one was a traditional IRA and one was a Roth IRA. Are you allowed to do that?
Yes, but it does get tricky. So what Brock's bringing up, client A, we'll say Brock here. Brock comes to me, he's got a traditional IRA and a Roth IRA, and he wants to invest in a trust deed investment. Can he do that? The answer is yes, as long as it's set up at the same time, that investment, with the traditional and Roth IRAs. So you can't invest in a traditional IRA, your traditional IRA dollars in a trust deed note, and then assign your Roth IRA over later, because that would be considered self-dealing. But if they went in together on a note, whatever percentage they went in at, so if it's 50-50 or 75-25, whatever, and then they would get paid out in their respective percentages as long as they set it up from the beginning. But yeah, that's available. It's a little bit more tricky, but it's definitely done very frequently. But getting back to here, so self-directed IRA. So self-directed IRA is really a marketing term that our industry uses to differentiate ourselves from normal brokerage house IRAs and the fact that we allow these non-traditional assets in them. But putting money in a self-directed IRA is just like putting money in any other IRA with a brokerage house or insurance company. So if you have money in an IRA with a brokerage house, we can do what's called a trustee-to-trustee transfer and transfer cash or assets from that IRA over to the IRA with us. You're allowed to do unlimited trustee-to-trustee transfers with your IRA on an annual basis, just moving from one custodian to another. Now, if you have funds that are in an employer plan, like an old 401k or something like that, you'll want to do what's called a direct rollover. So in that case, you'll contact the old plan administrator and say, hey, I have a new IRA. I need to do a direct rollover to this IRA with our custodian. I work with American Estate and Trust as the custodian, and so you give them their custodial information, and they'll write a check and send it to your IRA, which we'll put into your IRA account. You don't want them to send you a check because they'll take taxes out of there initially if they make the check payable to you. Now, a big frequently asked question I get here that I like to bring up, people will ask me, well, what about my current company retirement plan? Can I move that over to an IRA? And the answer to that question is maybe. It depends if your plan allows what's called an in-service rollover. While you're still in service in the plan, are you allowed to roll over any cash to an IRA, whether it be self-directed with us or with a brokerage house or something like that? Generally, 401k plans don't allow this unless you might be 59 and a half or older, but other types of plans, like defined benefit plans, might have some clauses that allow people to do that at a younger age. But most of the time I see this, it's somebody's old retirement plan from an old job. And the third and final way to put money into one of these self-directed IRAs is with an annual contribution. You'll note here I left the 2016 limits up because from now until generally April 15th, you can still make contributions to an IRA for the tax year 2016. Most people that have a normal W-2 job fall under the traditional or Roth IRA where they're allowed to contribute up to $5,500 a year. If they're over 50, there's a little catch-up provision where you can throw in an extra $1,000. And then we have some of the kind of high, pseudo group plans. So a simple IRA is similar to a 401k. This is where a company can set up this plan and allow employees to defer a little bit more than a traditional Roth IRA, but not quite as much as a 401k plan. And the match from the company is much smaller. So we'll see this from time to time, but not too frequently. The things I see most are the SEP IRA and a solo 401k, which are similar products. But SEP is an IRA. It's a self-employed pension. So for the self-employed person and perhaps their employees, where you can contribute up to 20 to 25% of your adjusted gross income to the plan with a cap at $53,000. Now the solo 401k, that's also a plan for the self-employed person, but it's a much for these types of investments, the hard assets, the alternative assets, I personally believe that the individual K or solo K is a superior product because there's two ways to make contributions to the plan to get up to that $53,000. And actually in 2017 now it's 54, but we're using 2016 numbers here. And I'll get into the solo 401k here a little bit deeper in just a second. But for most folks, they're opening up an IRA with us. There's a link I can send people to open up an IRA in a matter of minutes. And then we have to work on funding the IRA using those methods we discussed earlier, whether it be a transfer, rollover, or annual contribution. Excuse me. And that process can take anywhere from a couple days to 2 to 3 weeks, depending on how liquid your funds are and what company those funds are with. So you really want to try to get set up and at least talk to me about, hey, Brian, what do you think on this? How quickly do you think I can move this account over? But then in funding the investment, we're generally very quick. So if somebody like Brock has a trustee investment that you want to invest in and your funds are in the IRA with us, liquid and cash, we can generally fund that thing in about 2 business days. And so that asset's in your IRA with us, and you're off and running from there. But sometimes there's reasons that people want to have a little bit more control and have those funds at their fingertips. And that's where the self-directed checkbook IRA come in and a solo 401k, and I'll talk about those a little bit here now. So with the checkbook IRA, what we do is we set up an entity that your IRA owns, and you direct the IRA custodian to invest in that entity, and you open up a bank account for it. And then you're able to go get in investments on your own. Now this is very helpful for people that might be fixing and flipping a property, people that are investing in non-performing notes, people that like to go buy properties at courthouse steps, things that there's a lot of touching that needs to be had that you might not have time to go back through the IRA custodian for. And the 2 main ways you'll see this are done through either an LLC or a business
Brian,
trust.
Can I add just to that? If you want to jump back to that slide, that checkbook IRA really eliminates the headache of submitting the buy-sell authorization form to the custodian. And as a lot of my investors use a self-directed, I'd say almost 40% of my investors use their self-directed IRA. They begin to recognize just not the difficulty, but just the time-consuming process of putting together that bi-direction letter, submitting it to the custodian, and then all the underlying documents, and then waiting for that custodian to wire the funds back out. And so I've always directed investors to spend the extra cash, set up a self-directed IRA checkbook account, and then you eliminate that entire process and can jump on investments, in daily.
You can wire the funds that same day. That's where it helps, especially if you get a last-minute deal. Just to ease a transaction with one of these retirement accounts with check control is great.
Now, one thing to take into consideration, Brian, and I'll jump in one more time. One thing to take into consideration on that is, you do need to recognize that you have full control over those funds, and so you have to be careful not to do a transaction that might be that might place your account at risk. Prohibitive account, prohibitive transaction.
Exactly. Now, most places that you'll see do these checkbook IRAs, they'll do this using an LLC method, where your IRA becomes the sole member, and that you, the IRA owner, become the manager, which is fine to do. This goes back to a court case called the Swanson case in the mid-90s. So you can set up one of these, and if it's a single member entity, as we just discussed, the IRA being the one owner, it's called a pass-through or disregarded entity. However, here in California, there's a little bit of a wrinkle to that. The Franchise Tax Board here in California charges $800 a year for the right to have that LLC. And also there is a gross receipts tax that the LLC could be subject to. And the gross receipts tax generally is when there's over $250,000 in gross receipts. So not your net earnings, your gross receipts. So that could be even more than $800 a year, which is why I believe here in California the business trust is the way to go for your checkbook IRA controlled needs. Similarly to the LLC, when it's a single member entity, it's a pass-through entity federally. No federal attorneys to be filed. But the trust, this business trust, follows federal guidelines on where the first goes. So federally, if it's a pass-through, on the state level it's a pass-through, so you don't have to file with the Franchise Tax Board or worry about paying the $800 a year fee. So if you have any more questions on that, you can look at my independentira.com site or my retirementcheckbook.com site. But again, I kind of went through some of these things here. Then I want to touch again on the solo 401k, or as we call it, the 1K. So a 401k is that you'll hear in self-directed retirement account terms is generally talking about a solo 401k or a uni-K, or what the IRS deems a one-participant 401k plan. So this allows self-employed individuals, doesn't matter if they're just a sole proprietor or they've set up an LLC or they're incorporated, they can have their own 401k plan just like a big company. And there's some big benefits to doing that. You can contribute, and this is 2016 numbers, up to $59,000 a year if you're over the age of 50. So how it works is you, as the employee of the plan, can defer out of your pay, and it's either adjusted gross income or your W-2 earnings, depending on how you're set up as self-employed, up to $18,000 a year. You have the ability to have that be a Roth contribution, doesn't matter your income level, or a pre-tax contribution. If you're over the age of 50, that number jumps to 24. And then you can do what's called the profit sharing contribution, with a company match. And the company can match, depending on how it's set up to 20 or 25% of its income. That goes in pre-tax, but it caps out at it was $53,000 for the year 2016, with that catch-up contribution up to 59. That number went up to $54,060 for 2017. So some big benefits if you're buying real estate or you're investing into a company or private placement that gets a loan to buy real estate. You're not subject to a tax that an IRA is, something called UDFI, and that's a whole other webinar to get into. But if anybody has questions, feel free to ask me. I went through these contributions a little bit later, but essentially we set up this 401k plan for your company. It gets its own tax ID number, and you can either open up a bank account or brokerage account with that and invest directly into investments, or some people even set up one of these business trusts for anonymity sake in doing their investments. So we don't have to create the corporation for you, but we create the 401k. You can roll over existing pre-tax retirement dollars, and then you're ready to invest. So that's pretty much all I have, and I'll turn it over to Brock, and while I'm doing so, see if we have any questions. And Brock, feel free to jump in.
Yeah, I just want to say that I have worked with Brian for the last 8 years, and he has set up my self-directed IRA and then also my solo 401k for my company. And I can't tell you enough about, not only is he professional and getting the account set up, but he's there to answer any questions after the fact. Self-directed IRA, isn't as easy as just setting it up and running with it. You're going to have a lot of questions. Your accountant may have a lot of questions, and so it's nice to have Brian there to ping every once in a while and to ask if a certain transaction may be prohibitive. What other items we can do with our self-directed IRA. So I do give him 2 thumbs up.
Well, thank you, Brock. And while Brock's getting set up here, I got a couple questions I see popped in already. One of them says, so you're not a custodian, you're a third party. Yeah, I'm a third party. I do work with a custodian out of Las Vegas called American Estate and Trust, and all assets are in the name of the custodian. So I work directly with them. I'm an independent agent with them, so I do work directly with an IRA custodian. And then I have a couple other questions here. What about viatical life policies? Now, people do invest in those viatical type life policy, life settlements, but they generally do so through a private fund. So there's some type of private placement fund that's set up that invest in them. It's not directly into that life contract. And another person asked, what about investing with my son? Again, your son would be considered a disqualified person, is not somebody you could invest in. So with that, let me see. Best way to contact me, again, I'll have that up at the end, but you can reach me at independentira.com, Brian at independentira.com, or any way there. So we will get this going right now. Brock, I'll turn it over to you.
Hey, Brian, thanks so much. Just number one, can you see my screen okay?
I can see your screen fine.
Perfect. And secondarily, if you have any, those that are attending, if you have any questions, feel free to use the chat button. Brian, I don't seem to be able to see the questions that are coming in, so just stop me with any questions. I love to answer questions. This is going to be a broad cursory view of trust deeds and investing in trust deeds. It can get very detailed, and there can be some complex issues, so feel free to ask me those questions. Hopefully I can get an answer to you immediately, or if not, after the fact. So Brian, thanks again for involving me in your quarterly webinars. Today I'm going to be talking to you about investing in trust deeds. Trust deeds are an excellent option for investors that are looking for consistent income, looking to invest in the real estate sector, and people that are looking to invest locally. I am the president of Talimar Financial. I have been the president, and I run Talimar Financial for the last 8 years. And our company is specific to financing real estate investors who flip houses, who build houses, and who need short-term bridge loans both on commercial and residential real estate. Our platform allows for trust deed investors to actually invest in the loans that we originate. And so we act as kind of that platform for investors that are looking for trust deeds, but then also want a third party to manage that trust deed on their behalf. So over the next about 30 to 45 minutes, I'm going to talk to you about basically what is a trust deed investment. We're going to talk about why you want to invest in trust deeds. Is it an appropriate investment for you? We're going to be talking about structuring a trust deed to maximize the return that you get, but then also to minimize the risk. We're going to talk about collecting payments on your trust deed investment, and then locating the right trust deed for you. And then I'm going to give you some real-world common mistakes that trust deed investors make. I've probably made all of them over the last 10 years, and so hopefully I can give you some ideas of mistakes that you don't have to make. And then I'll leave it up to questions and answers. Number one, I want to say trust deed investing is risky. Yields range from 8 to 12%, and in order to get that yield, there is risk. So I always advise people that invest in trust deeds, only invest in trust deeds, number one, if you don't need that income consistently. If you need that monthly payments and that borrower stops making a payment, and that's going to affect you negatively, don't invest in trust deeds. Number two, again, don't put all your eggs in one basket. Don't put all your money in trust deed investments. But again, it's a great option for investors that are looking for consistent income, looking for to invest in the real estate sector. So I'll start off and tell you a little about myself. I actually started in the real estate world. I graduated the University of Michigan and got my first start in real estate as a financial analyst at KeyBank. Under KeyBank, within KeyBank, we were originating what's called joint venture mezz debt opportunities. Effectively, what we were doing were funding or joint venturing with small residential and mid-sized residential developers on their project. It was a great opportunity for me. I was the guy that was sitting behind a desk on a computer running Excel spreadsheets for close to 5 years on deals. Now, when 2006 rolled around, unfortunately, it really negatively negatively impacted our fund, and so I had the opportunity to look for a new position. And that's when shortly after that I accepted what's called a term appointment with the FDIC. The FDIC, as you may be aware, are the government entity that insures your deposits at banks. About 2008, about that time, is when the FDIC started shutting down a lot of banks. So what we called it, we had facilitated the orderly dissolution of failed institutions. Effectively, we went into those failed banks. If you saw 60 Minutes coming in on a Friday night, we'd walk in and we'd close the bank down. And then my job was to underwrite all the loan assets of that bank over the weekend, take control of those, manage those loan assets, and then I would sell those that debt effectively off to the private sector. I did that for about 3 years. It's about 3 years of traveling from bank to bank to bank. And then as the financial industry started to stabilize, fewer and fewer banks were being closed. And about that time, I transitioned out and created Talimar Financial. At that time, I was just simply lending money to my buddies who were flipping houses. I didn't really know there was a full industry on trust deed investing, and I was just lending the money. My friends didn't have any source of capital. One thing I did was to save money, and so I just used the money to finance their projects. After about a year of that, I figured out there was an actual industry around it, and so we just started to grow our origination platform, doing more loans with more borrowers, and then I opened it up to friends and family to actually invest in the loans that I was originating. And then from there, we've grown to where we are today. So we service an active loan portfolio of about 17 million. That's about 60 loans. I'd say about 30 of those loans are existing construction or rehab projects. I manage about 140 individual investors, all the way from an investor that has simply 50,000 all the way up to investors that have 2-3 million with us. We originate about 2 million in new trust deeds every month. So we have a pretty healthy pipeline for investors that are looking for specific trust deeds or constantly rolling their funds over as their trust deeds pay off. So I talked a little earlier about what are the advantages of trust deeds. And this is the #1 advantage that I like about trust deeds is they offer fixed monthly income. I know what yield I should get every month from the trust deed investment. And so typically a trust deed investment return is going to range between about 8 and 10%. That's what you should expect over a given year, which is substantially better than placing your money either in a savings account or low yielding bond fund. The other advantage of trust deeds is that it's secured by real estate. Now I know we're coming out of a 2008 to 2010 real estate slump, but I think we all recognize that that real estate here in Southern California, or at least over the long term, is going to be relatively strong. They just simply are not building enough homes in Southern California for the population that's increasing here. And so I think the value of real estate should, over the long term, continue to climb. Obviously there's going to be short-term impacts or shocks to the market that might negatively impact it. But again, we're looking at a long-term horizon on real estate. So that's why I like it. Again, another advantage to trust deeds is that they offer attractive returns. I would say 12% is probably pretty high unless you're taking a lot of risk on your trust deeds. But you know, most trust deeds at what, and we'll get into kind of the loan to value ratios and what that means, but a typical trust deed in first position is going to earn you around 8 to 10% here in San Diego. And again, that's a pretty healthy yield for the moderate risk that you're taking. Please stop me if you've got any questions at this point. Please stop me and I'll be more than happy to answer those for you. So I talk about low to moderate risk. When you invest in trust deeds, you can take very low risk trust deeds, which means that a low risk trust deed would be low loan to value. So your loan amount compared to what the value of the real estate is. So if you're doing 25% loan-to-value loan on a single-family house here in San Diego, that's a very low-risk trust deed. If that borrower stops making payments, more than likely the sale of that property will be able to get you back your principal investment and any interest that was unpaid. Now, on the other hand, you can go as high as 80-90% loan-to-current value on a trust deed, and that's going to earn you yields of closer to 12%. But you're taking substantially more risk. If you were to force to sell the property and you're at 90% loan to value on a property, that 10% spread may not cover your outstanding principal and unpaid interest and then legal costs to do the foreclosure. So a good trust deed typically is capped at 65% loan to value, and that's what I call a moderate risk trust deed. The other thing that I really like about trust deeds is that you can invest locally. I have no problem investing out of state. A lot of people go to Arizona. Georgia seems to be a big market to go to. Florida, Nevada. You even see a lot of investments now coming out of real estate investments coming out of Washington and Oregon. But I like the idea that I can actually go down and look at the real estate asset that I'm using as collateral for my trust deed. I can look around the surrounding neighborhood. Is it a good neighborhood? Is it a poor neighborhood? Is it getting better or is it in decline? What can I expect over the duration of that trust deed? So that's why I like to effectively kick the tires of the real estate that we're using as collateral. And then the final thing that is nice about trust deeds is that your ability to what we call fractionalize. So the average loan size that we do is around $300,000. For most investors, a single $300,000 investment is just simply too big of an investment. And so we allow investors to come in on a fractional basis, so they can invest $50,000 into that $300,000 investment. For a lot of investors, that makes more sense, so they don't put all their eggs in one basket. So you can take a small percentage interest, a 20 to 30% interest in a trust deed. And then finally, the ability to use a self-directed IRA. So I have a lot of investors that use a self-directed IRA to invest in trust deeds. Now the advantage of using a self-directed IRA obviously are the tax advantages, but then also to unlock those funds that are in a retirement account. If you don't feel comfortable about placing those funds in a stock market or bond fund or what have you, you can actually use those funds to invest in assets like trust deeds. And someone like Brian can definitely help you set that account up and get you moving on that. But I would say that about 40% of our investors use some form of a self-directed IRA or 401k to invest in trust deeds. All right, so what is a trust deed investment? Trust deed investment is simple, and this is just again, a 30,000-foot view of a trust deed investment. You, the trust deed investor, are in the capacity of the bank or the lender. All right, so you're lending money to a borrower and then using their real estate as collateral. So if that borrower stops making payments, you can force the sale of that real estate collateral to repay your loan and any outstanding interest and fees and whatnot. So what we have here is step one, you are the lender. You are lending the money in step two using a promissory note and a deed of trust. That deed of trust is recorded against the property, and then at that point the borrower starts making payments to you. And then once they repay that loan, you go out and you can do another trust deed. So let's go into the structure of a trust deed. So like we spoke about before, you, the bank, the lender, or the trust deed investor, lend the money to a borrower. That borrower signs a promissory note promising to pay you a certain interest rate over a duration of time. Now, in order to collateralize or to secure your investment, you want to ensure that that borrower has a real estate that you can use. So we record what's called a deed of trust against that property. And what that deed of trust is notifies the world that you have a lien on that property. Now, a lot of people talk about what's a first trust deed or what's a second trust deed. A first trust deed simply means that you are in first position as a lien holder to get repaid. That property is either sold or refinanced. Now, a second trust deed simply means that you're going to get paid second after that first trust deed lien holder is paid whole to get your money back. And you can understand when you're in first position, you're in a much more secure position than if you're in a second position. You, as a second position lien holder, you got to ensure that that first trust deed lien holder is completely paid off before you see any of your money. So I highly recommend, if you're going to just start off investing in trust deeds, invest locally, number one, but invest in first trust deeds. It gives you just the security and ease that you're going to most likely get your investment back in the interest. Second trust deeds get a little more complicated because you got to stay on top of the borrower, if they're, ensure that they're making their payments on the first trust deed, and if they're not, work with that borrower to bring that first trust deed current. Okay, so what are the risk factors of trust deeds? So I alluded earlier in the conversation that you should stick around, a good rule of thumb is 65% loan to value. 65% has kind of just been a long-term figure that many seasoned trust deed investors use to limit how high of a loan-to-value ratio they would go on a piece of real estate. So when I say loan-to-value, again, if I lent you, the borrower, $50,000 on a real estate asset that was worth $100,000, we would have a 50% loan-to-value ratio. Now, you move that up to $65,000, you're now at $65,000 loan-to-value. So $65,000 of that $100,000 value of that real estate, you're at 65%. Anything above that, you're starting to get into a risk zone that if you were forced to sell that property, that there would be enough funds coming from the sale of that property to repay your loan. So again, good rule of thumb, 65% loan to value. Secondarily is, what is the borrower's ability to pay? Now, we as trust or as a private lender, we do a lot of construction and rehab loans. So, we understand that the borrower's repayment schedule is going to really be based upon the sale of that property. If they stop making just monthly payments, we're going to force sell that property, but the eventual sale of that property will repay our loan. Now, more popular up until about 2008 with the new laws that came in that really prohibited owner-occupied type trust deeds, was that borrowers would go out to the private marketplace. They may own a home, they may not have credit, or for whatever reason they needed to go to the private lending industry to get a loan for their home. And so you would lend at 65% loan to value, kind of followed your gut, but you really never figured out how were they ever going to make the payment. Do they have a job? Do they have a steady income? You really want to understand, ask the question, where is the income going to come from to pay my the monthly payment on the loan? It's all fine and dandy that I'm at 50% or 65% loan to value on the real estate asset, but you're not using that figure as your sole reason why you're going to invest. Going through the foreclosure process, though not complicated, it really isn't the process you want to go through when getting involved in trust deed investing. I talk about exit strategy. When you work with a borrower and you're lending them money, you want to understand how they're going to repay you. Again, we do a lot of rehab and construction loans, so I know my eventual repayment is going to occur from the sale of that property. That's probably going to be about 80 to 90% of the trust deeds that you get involved with, is the repayment will occur from this eventual sale of the property. Now, in other cases, there may be a refinance that's happening down the road. Let's say a borrower owns a commercial real estate asset and he needs to do some tenant improvements. He doesn't show the income that a bank would want to see to do the loan, so he may go out to the private market, get a loan from a trust deed investor, and do the tenant improvements. At that point, he brings in a tenant who then starts paying income, and at that point the bank would feel more comfortable doing the loan and then repay you through the bank loan. And that's another relatively common exit strategy. But ask that question, how are you eventually going to repay my loan? Because as much as I like to have the income, I like to know that I'm going to get paid back at some point. This is important. The strength of the real estate asset that you're using as collateral. In San Diego, the majority of loans that we do are single-family homes. I think that's a very strong asset in San Diego. Number one, it's the most liquid type of asset. that's the type of asset that sells most in San Diego. The lenders are there to lend money for people to buy homes. Secondarily, they're just not building enough homes. And so the value, over the long term, you should see the value of single-family homes continuing to rise because there just isn't enough supply for the demand out there. Assets that don't have a lot of strength or that there's a lot of value change in them is land. That's probably one of the worst assets that you can lend against because the value of land is only what the future use of it is. So unlike maybe like a parking lot that has consistent income coming in, land has no income. And so the borrower may come to you, and this is a very common question I get is, look, Brock, I want to buy a lot and I want to build a home on it. Well, we don't know at that point if that lot can even, a home can even be built on it. Or that borrower may buy a lot to put a 4-unit apartment building on it. So that borrower has to go out and get approvals for what he wants to build on it. And the land value, what he's buying it at, is based upon the fact that he could get those approvals to build on it. So land really is just based on what the future use of it is, and if that person isn't able to build a 4-unit apartment building but can only put a 1-unit single-family house on it, the value of that land significantly declines, and then that would compromise your loan-to-value ratio. And so I always suggest to first-time trustee investors, stay away from land, stick with easy assets like a single-family house, something that's kind of in the middle, that's a more difficult asset to value, maybe commercial real estate, because you just don't have as many users and buyers for commercial real estate as you would on single-family houses. Duration. Now this is a big thing. When I first started investing in trustees and bringing outside investors in, a lot of investors wanted 3 to 5 year terms on trustees. Now that's great because you get, your time horizon is much longer. Your earned income, 3 to 5 years, you don't have to play around and find another trustee. But most of the trustees that we have are only about 12 months, which I think kind of wears the industry standard now. Obviously longer term may be better for a lot of investors, but I always see market risk involved with that. So if I can do a short-term trustee, I know that I can roll those funds over to another trustee after 12 months. And if I start to see some market changes, maybe that the housing market's starting to slow down, I can adjust my loan-to-value parameters, bring it down a little to compensate for any market changes that I may see in the future. So the shorter-term trustees aren't as bad or as important as an issue to me as maybe other investors who are looking for a longer-term cash flow play. And then your risk-adjusted return. Look, if I looked at my portfolio today with all the loans that we have done, I have an average loan-to-value ratio of about 52 to 53%, and the average yield on that loan is about 9.75%. That's a pretty good risk-adjusted return. Take into consideration that does include trustees back in the 2008 to 2012 timeframe where I could get a 14 and 15% yield at 65% loan to value. Nowadays, with the amount of capital that's coming into the market, in the private lending market, and really the real estate values showing continued price increases, the 65% loan to value ratio on single family homes here, let's say in more urban San Diego, you're going to be closer to the 8 to 9% range. Now if you want to go out east, Riverside, San Bernardino, you might be able to get a little stronger yield, but you're taking a little more risk because that real estate out there doesn't sell as quickly, and you might see more price volatility in that type of real estate. So let's talk about what are the primary elements of a trust deed investment. Well, number one, and probably one of the most important items, is you have the promissory note. The promissory note just lays out the terms of the loan to the borrower. So who is that borrower going to repay? What is the duration of the loan? What is the amount of the loan? What is the monthly payment of the loan? And then other details that might be associated with that loan. So that promissory note is what the borrower signs and gives to you as a promise to pay in the future. And again, that's what we call a negotiable instrument. So you want to have that in a file and available to you as the original. Now you have the deed of trust. The deed of trust is simply the document that you record with the county recorder against that property, and that puts a lien on that property. So if that borrower were looking to sell it or refinance it, they could not pass title on to another buyer or seller or another buyer of that property without removing your lien, or that borrower, or if they were to, the lien would remain on that property with the new buyer, and the buyer probably wouldn't take the property because that lien exists on it. Assignment. So what an assignment simply does is assigns the interest in that deed of trust from party A to party B. So we, as a private lender, are required typically for our borrowers to fund within 3 to 5 business days. That leaves very little time for me to actually go out to my investor base, raise the capital, and get them involved in that loan day one. So we actually self-fund a high percentage of your loan. So borrower A comes to me, says, Brock, I need a loan in 3 days. I'll underwrite that loan, I'll fund it for him, and then I make that loan available to investors after the fact. Now, when an investor comes into our loans, we assign an interest in that loan to them. We actually record a document against the deed of trust that states investor A now has a 50% interest in that loan. And so that when that borrower goes to sell the property or refinance the property, that lien cannot be removed from the property without investor A's notification and agreement to it. Just one thing that's really important, when you do invest in trust deeds and someone brings a trust deed investment to you, you have to make sure that they're going to assign an interest in that deed of trust to you, so that if they were to disappear or you can't get a hold of them, it really doesn't matter, because you have a interest in that deed of trust, or recorded interest. So nothing can happen from the payoff of that property until you are notified. One of the biggest scams, I think, for the trust deed investing world is that you get involved in a trust deed, but that broker never actually records an assignment, and then he goes and once that loan is repaid, takes the money and fails to tell you that your loan has been repaid, and then walks off with the cash. Title insurance, super important. Title insurance, what is also known as a lender policy, ensures your deed of trust, so that once you close, that there aren't issues with the property or the title, more importantly, the title of the property, that might jeopardize your loan. So maybe the taxes are brought current, that there are no other lender liens on the property that might take your trust deed that you thought you were in first position, but now you're in second because there was an existing lien on the property that no one knew about. So that lender policy covers that issue, covers that for you. Here's a good example of not that I made a mistake, but that an issue that popped up. I funded a hard money loan on a fix and flip in Vandenberg, and my borrower had purchased the property from the bank. Well, the prior owner lost the property to the bank, but was suing the bank because prior to the foreclosure sale, he split a very minute piece of the lot and put a new APN number on it. And so he was suing the bank, stating that you couldn't take the entire property because the loan that the bank had was only for the one APN number, not the new APN number for the small piece of land that he had on his lot. And it was good that we had a lender policy on that, because the title company actually covered our legal expenses fighting this borrower, who had no case to begin with, but fighting this borrower with that issue. And it took about 60 days to take it to court, and the judge quickly found that it was just a bad lawsuit. But it was nice to have the title company behind us paying for those costs. Property insurance. Now, when you use real estate or a real estate asset as collateral, you want to make sure that it's insured. You don't want it burned down, because now your collateral value has significantly declined. So when you get property insurance, that's going to insure your collateral. Now, if you had total destruction of the property, typically the insurer will pay out all the lien holders on the property. If you had a partial issue with the property that the borrower had to submit a claim, those funds typically go back to the borrower to repair that claim or repair the issue. One thing with property insurance, make sure that number one, you review the policy, but number two, that you're a named insured on the policy. It's very easy to do. You'll just notify the borrower, please send me the certificate of insurance showing Talimar Financial as an additional insured. Appraisal or BPO/property inspection. Inspection report. So obviously you want to understand what the value of the real estate is before you structure your loan. So you want to make sure that if you're lending on a real estate asset's value is $100,000, that you have a third party that's providing you evidence that it's valued at $100,000. So you can do that through what's called an appraisal, which is a full-blown appraiser goes out, takes a look at the real estate asset, inside and out, and then we'll provide you a full report on that asset and its value, or what's called a BPO or broker's price opinion, which is kind of a almost appraisal, where a broker will go out, maybe view the house from the outside, pull some comps in the area, and give you kind of an estimated value. Again, and then the inspection report is typically a property inspection report. That property inspector will go in and ensure that the asset is in good order, or if there's any issues that you're aware of, that you can discount the actual value of the real estate by the issues that the report comes up with. So we talked a little about one of the advantages of trust deeds was the ability to fractionalize trust deeds, and this is a common thing to do. So again, a lot of investors, the average loan amount that we lend out is around $300,000, and again, most investors don't have that amount of cash to invest. And so in this scenario that I'm showing you on the screen, you've got a situation where you have 3 investors, and in this case, each investor puts $100,000 towards that trust deed. Now, they will earn their yield on their $100,000. So once that borrower makes that payment, our servicing company, a servicing company is just a separate company that collects the payments from the borrowers and then distributes it to the investors, will earn their yield for their $100,000 on that property. So it's a great way of getting involved in trust deeds on a smaller loan amount. Now we usually require a minimum of $50,000 per trust deed. So if you have a $150,000 trust deed, you could have 3 investors in that at $50,000. Now the disadvantage, and this is really important to understand, of fractionalized trust deeds, is that you are sharing a loan with other people. And where the issue comes up is if that loan starts to go bad, you as a partial owner of that trust deed will have to cover your portion of the cost to foreclose on the property. So in this case, let's say the cost of the foreclosure is $3,000. You yourself would have to pony up $1,000, and every other party does. The issue, obviously, is you can probably see coming up here is maybe the third trustee investor doesn't have the $1,000, so you have to cover it for them. Or let's say the third trustee investor doesn't want to foreclose for whatever reason. Well, you then have to negotiate or find a reasonable strategy to foreclose on this property. Now, to overcome that issue, a servicing agreement is signed amongst all the trustee investors, which says, okay, number one, you need to pay your portion of the foreclosure costs. And then number two, the majority interest holder of that trust deed has final say as to what would occur in an issue of that trust deed. So in this case, we have a perfect percentage interest at 33.3% for each investor, but let's say 2 investors decide, if that borrower stops making payments, 2 of the trustee investors decide, yes, we want to commence foreclosure. Well, their decision will supersede the third trustee lien holder who may not want to. So one thing to take a good rule of thumb is if you do have the cash, try to become at least a 51% interest holder in a trust deed, because that gives you majority power, or get comfortable with the other investors. Make sure that they have invested in trust deeds and that they're willing to be aggressive. If that borrower stops making payments, to immediately go towards to start the foreclosure process. Now here at Talimar, we kind of have assisted in this, well, we do assist in the process of the foreclosure, but we actually put the cash forward to do the foreclosure. So we're not going back to each investor to try to get their percentage interest. We'll go ahead and fund it ourselves, and then we actually get repaid the money that we used to, or the money that we spent to do the foreclosure from the eventual sale of that property. Again, please, if you have any questions regarding what I'm talking about, please ask them. I'm more than happy to answer them, because some of this stuff does get a little complicated.
But this is very all-important stuff, Brock, if I might jump in. I mean, these are the things people, how do these trust deed investments work? So you're really getting into the nuts and bolts here. So a lot of good info.
Thank you. So all right, so now you've selected your trust deed, you've invested. Let's say you're a fractional interest holder in a $100,000 trust deed. You own $50,000 and party B owns $50,000. So what's next? Who collects the payments? Who's going to go do the processing of this loan? Well, I highly recommend, and we here at Talimar Financial, outsource the servicing of that loan. So many of you may have mortgages with a bank, and you may actually write that your mortgage payment to a third-party servicing company like a Bayview or someone else. Well, we use FCI Lender Services. They're one of the larger private lender servicing companies, and they've got pretty good rates. But you know, the nice thing that they have is that you can actually log into their website and see all the loans that you're invested in. So what FCI does is actually contacts the borrower, collects the payment from the borrower, and then distributes it to all the investors on the loan. Then they also offer monthly statements, and then your year-end statements and your tax statements. It is worth it to use a third-party servicing company, because the state of California has really amped up the regulations required, or just typical regulations to service your own debt, to service your own loans. So go ahead and pay the extra money to have a third-party servicing company that specializes in collecting payments do the servicing on your behalf. Additionally, FCI will actually initiate the foreclosure and do the foreclosure process for you. So if that borrower stops making payments, you can just notify FCI, would you please start the foreclosure process. Now here at Talimar, we actually remain as your point of contact. FCI does service our loans, and they're the ones that deposit the funds in your account. But if you have any questions regarding your trust deed over its life cycle, you would contact us. So that really just goes over the loan servicing company, and there's plenty out there. We use FCI. There's one locally, Del Toro, here in San Diego, that also does a really good job of servicing loans. So here's some tips on trust deeds. Number one, if you're new to trust deeds or you want to keep it simple, stick with first trust deeds. Obviously, second trust deeds and third trust deeds have a higher yield, but just think back and say, okay, is it worth my time and headache to manage a second and third trust deed over a first trust deed? So second trust deeds really depends on what kind of yields you may be getting, but you may be getting between the 10 to 15% range. But again, is it worth the extra money than having the headache and the headaches of just having a first position loan? I stick with most cases first position loans. Loan to value. I try to stick with that 65% loan to value rule of thumb. In some cases maybe I'll go up to 70 if it's a really good asset and the borrower has great credit and demonstrates great cash flow. We'll go maybe up to 70%, but 65% is a good rule of thumb. Understand your collateral. So we talked about this. What's the risk of the collateral? A single family home is the most liquid type of real estate you can have here in Southern California. And on the other end of the spectrum, land is the worst. So that is the hardest asset to sell, especially in a bad market. The values fluctuate substantially. You've got commercial real estate where that adds a little more risk factor because there's fewer users and buyers and sellers of commercial real estate. So I typically want to stick with single-family homes or multifamily. Multifamily is a very popular asset class. So let's talk about verify, exit strategy, and timing. So understand how long this loan is going to be. Is it going to be 12 months, 24 months, 36 months? Why does it need to be that long? And then understand how that borrower is going to pay you off. Are you going to pay me off from the sale of the property? Are you going to refinance the property with a traditional lender? I just want to know how you intend to finally pay me off. Borrower qualifications. Again, we talked about, how are you going to make these payments? What's your monthly income? Do you have steady monthly income? If you're flipping a house, have you ever flipped a house before? If you're building a house, have you ever built a house before? If you own commercial real estate, and let's say you're managing a real estate asset, have you actually managed a commercial real estate asset in the past? Or did you just inherit it and you need to get some money out and really don't know what you're going to do with this real estate? So understand the borrower qualifications. Now note that the borrower qualifications are not going to be as good or not going to be great. There's going to be some ding on the credit, something that they're coming to you with that they couldn't go to a traditional lender to get the loan. But just you want to understand what that issue is, and then how are you going to minimize the risk of that issue. So if the borrower has bad credit, well, why does the borrower have bad credit? When I first started this business, every one of my investors had lost homes. These were contractors, realtors. They just got hit by the market. And I understand what happens when the market gets bad. They let go of their houses. And I'm not all that concerned with that kind of ding on credit. What I'm really looking for is the guy that can't pay revolving credit lines, so credit cards, and other types of revolving credit lines that if they demonstrate a history of not paying those, well, most likely they're not going to pay me. Utilize experienced trust deed brokers. Very important. So there's a whole industry of guys like myself that actually go out and originate loans. You want to stick with people that have experience in that specific sub-market. So you always question, well, Brock, you're in San Diego, but you're doing trust deeds up in San Francisco. How well do you really know that market? How well do you know that borrower? And thirdly, why are you doing a trust deed in San Francisco? Is there something that a trust deed investor up in San Francisco knows about that borrower asset that they wouldn't do the deal and they came all the way down to San Diego to do it? So when you work with trust deed brokers, number one, how many have you done? How much do you manage? What is your process? And then, how experienced are you with this product type in this specific market? Mortgage pools versus individual trust deeds. Now, a mortgage pool, simply you invest in a pool of real estate assets. You've all heard about these funds that are out there, and they're great in the sense that you can invest in a multiple number of trust deeds all at once. But when the market goes bad, that actually is bad for you because you don't get all your money back until that last trust deed in that fund is finally sold off. So that can become a very big issue. And if that mortgage fund is losing money and the manager of that fund can't keep up his office, well, now you've got that mortgage fund with nobody really running it. And that became a big issue in 2007, 8, and 9 when a lot of these mortgage funds collapsed. I always suggest investing in individual trust deeds. You know exactly what trust deed that you're invested in. You know exactly the real estate asset. You know exactly the borrower. So if the market does go bad and that you're forced to foreclose on the property, at least you're just foreclosing on one property, not hundreds of properties. So stick with individual trust deeds, know that trust deed, know that asset, know that borrower, and then know that mortgage broker. So we're coming at the end of my webinar here, but I want to give you an example of a trust deed that we financed this was about 1.5 years ago. So a lot of cases we do what's called fix and flip loans. So the borrower's intention is to acquire a property, rehab it, put it back on the market for sale, and then once that property sells, that's when we get repaid. So we typically underwrite to the actual completed value of that property. So in this case, the value of the asset once done was $300,000. Our loan amount was $195,000, so we're at 65% of completed value. It was a single-family house. And so the after repair value at $300,000 was a great value in the sense that that's a first-time home buyer product. So a $300,000 home is going to sell much quicker than a $10 million home in downtown La Jolla, or if anyone's listening from LA. And so I like to stick with first-time home buyer product when I do fix and flip loans because I know that that asset's going to sell quickly. It may not sell for $300,000, it might go down to $290,000 or $280,000, but I'm still in a good position on my trust deed. In this case, the rate was 10.5. It was located in San Diego. The borrower had funded $115,000 of their own cash, so they had a substantial amount of cash in the deal. So even if they were to lose money on the project, they were going to want to recapture some of the money. So I mean, I felt that it was a good risk-adjusted return. Our term was 12 months, though the borrower was in and out of this project in 6 months. The borrower actually had good credit and had a substantial track record of flipping houses, so that really went for him. And then we offered this trust deed at $50,000. And so I think in this case we actually had one investor take the entire trust deed, but we did offer it at $50,000 minimum. And then our loan servicing agent was FCI Lender Services. So once we closed it, we do what we call boarded the loan with FCI, and they were starting to collect the payments from the borrower. So why Talimar Financial? This is a little plug for us. We offer a platform to invest in trust deeds, so you can actually go to our website, and if I can show you here, tell you exactly how that would work. You would go to Talimar Financial, and you could go actually to our available trust deed site and look at what available trust deeds. So if you were to go under investors, go under available trust deeds, you could actually view all the trust deeds that we have available, right? So right now, all the trust deeds, we have $0 available in any of them right now, but we will have a couple more posted tomorrow. The other thing that we do is we really finance projects locally, and so you as an investor can always go down to that property, you can take a look at it, and then you can also always take a look at it once invested to see how those renovations are going. We do manage the trust deed over its entire life cycle. So once you have selected a trust deed that you want to get involved with, we get you involved in it. We don't walk away, we don't go away. We actually remain as your point of contact throughout the entire life cycle of that trust deed. If you've got any questions regarding that trust deed, you would give me a call and I'd go ahead and answer the question for you. Again, we talk about assist with questions and issues. So we've had issues in the past where a borrower may get in trouble and stop making payments. So we're going to work with you as the trust deed investors to initiate the foreclosure process. And then we'll walk you through that entire process, and once that borrower pays that loan off, make sure that you get your principal back and your distributions that you were to earn. And then I've been investing in trust deeds and been involved in trust deeds for almost 10 years now. And so we've got a track record of doing a lot of deals here in San Diego. So we talked about available trust deeds, or talked about the advantages, the fixed income, the security of real estate, the attractive returns, the low risk, or I say moderate risk, the ability to fractionalize, the ability to invest locally, and then really the ability to work with groups like Brian Davis and independent IRA services to use your self-directed IRA to invest. So that about does it. I really appreciate your focus, your time today. I know we covered a lot of information. Please let me know if you've got any questions. I don't, again, Brian, I don't think I have access to the questions, so let me know if there are any. And then we'll also post this on the web, and if you want to just review it, we'll go ahead and post it on our website.
Yeah.
Please visit Talimar Financial.
Yeah, Brock, thanks so much. And Brock, all his contact information is right here, Vandenberg at talimarfinancial.com, or his website, talimarfinancial.com. And just want to say that, working with Brock is, was the catalyst of me doing trust deed investments, and Brock's been very helpful in helping me do so. And you can tell by just the education of the basics of trust deed investing. And sometimes people think that's real simple, but they just don't know it. There's not a real good place to see it. So this webinar was a great avenue for that. So I want to thank you, Brock, for that. They had a question here. How often do you update your website with deals?
So we will update it when trust deeds come in. So usually we update it twice a week. But if you'd like to go to our website and let me get this out of the way here. Go to our contact us page, or contact us part, and put your contact information in there. I can put you on our email distribution list. And then as new trust deeds come available and we post them on the web, you'll get an automatic email from us notifying you that the new trust deed has come available.
All right. And another question here. If and it seems, I'll answer part of it. It seems right now you have a lot of investor cash out there coming in, but do you stay in on some of these notes yourself if you don't get enough investors for it? Do you stay in on those deals, or do you keep going until you get an investor to take you out?
The game or the difficulty we have in running and what we do is always a balancing act of the available capital to the amount of deal flow we have. So if I know that I have a lot of capital that's sitting on the sideline that wants to get invested in trust deeds, I can go out and locate more trust deed investments. And then on the flip side as well, if I don't have a lot of capital available at that moment, or I will lay off trying to find new trust deed investments. So it's always a balancing act. We have the available capital to do about 17 to 18 million. But it really depends. I mean, some of those investors are really specific on the types of assets that they're going to lend on. Some people only want land. Some investors only want to take that high-risk land. Some, want only single-family homes, in Carlsbad. So it really depends on the types of trust deeds that come in, and the type of demand that an investor would have for that type of trust deed. But I always highly suggest, if you're interested in learning more about it, go to our website, send me your contact information. I'll be more than happy to send you emails, updates on trust deeds.
All right. If anybody has any last-minute questions, put them in now. I'm just going to show everybody my website at independentira.com here and let you know that Brock and I will be posting this on our social media sites with a link hopefully later today, but my contact information is here. Feel free to contact me at brian@independentira.com or go onto my site, independentira.com. And Brock, I want to thank you again for the great educational experience of investing into trust deeds and the whole life cycle of the trust deed, and with examples of how Talimar Financial does it. So thank you very much.
Well, Brian, again, thanks for having me on with you, and these are great webinars to be a part of.
All right, everybody. I'm going to stop the recording, and if anybody has any questions, feel free to reach out to Brock or I.
Great, thank you.